Hello, my name is Travorce Carnes, and thank you for attending our webinar today, the CFPB Update webinar. Our webinar today is sponsored by Movement Mortgage and Allison James. Our speaker for today is Shelly Hoiseth and Jeff Jabora. I'll now turn the floor over to Mr. Jeff Jabora.
Hi everyone, thank you for attending today. My name is Jeff Jabora and I am the Director of Growth and Development here at Allison James Estates and Homes. We want to thank you very much for attending today. One of the many benefits of working with our brokerage is keeping 100% of your hard-earned commission. In addition to that, our goal is to give back to the agents by way of education and all of the tools that we offer. We believe that education should always be free. We always reach out to agents outside of our brokerage and invite them to all of our events, be it webinar, live events, you name it. We always have some kind of training or education event, and we always invite as many people as possible. We have a lot of great things going on with our brokerage. Once again, keeping 100% of your commission is a huge advantage, and there's a lot of great things about that other than the obvious. If you have any questions about that or more interested in our brokerage, please don't hesitate to give me a call. You will receive my contact information after the webinar as well. Without further hesitation, I'd like to turn it over to our wonderful speaker today, Shelly Hoiseth, Senior Loan Officer with Movement Mortgage. Thank you, Shelly.
Hi, Jeff. Thank you. Yes, I am Shelly Hoiseth. I am a Senior Loan Officer with Movement Mortgage. And just a little bit of a disclaimer, my job is to originate loans and get loans through closing. So I am not normally a compliance trainer. However, I do have a good understanding of the updates, and I am happy to share them with you. So I'm going to just get going without further ado so that we can keep everybody out of here as quick as possible, right? I know you're not all excited about learning about CFPB. So I'm just going to jump right into it. The CFPB is the Consumer Financial Protection Bureau, and TRID is the Truth in Lending Act Real Estate Settlement Procedures Act, which is the TILA-RESPA Integrated Disclosures Act. Basically, what that is we are integrating into new disclosures, and we got some additional wait times that are going to be involved in the closing process. These were originally going to take effect August 1st, and the CFPB has put out an announcement that they are delaying till October 3rd at this point, and we'll know more as we go along. So as I go through this process, I'm not necessarily going to read all this verbatim. So for those of you that are real technical in that, don't get disappointed when I don't read every word. So basically, there's going to be two new forms. One is the loan estimate, and this one is going to replace the original good faith estimate and the TIL, which is the truth in lending statement. Those two will be eliminated and replaced with one combined form, which is the loan estimate. The closing disclosure is the second new form, and that one is going to replace the what is now the HUD-1 and the previous final TIL disclosure. So basically there are some additional changes. Number one, doesn't necessarily reflect to you guys. It does say that we have to have an affirmation from the borrower before we can collect all of their documentation, W-2s, pay stubs, etc. Well, you might be wondering, how are you going to get a formal pre-approval if we can't gather this information until the client is officially moving forward? Basically, we will be doing things pretty much the way we did before. When we do a pre-approval, we will request items from the borrower, and if they choose to supply them, then we'll be able to complete a full pre-approval. Otherwise, we'll wait until we have the 6 pieces that makes it a loan application, which includes the property, and then we can do a full pre-approval. But in most cases, when clients are requesting a pre-approval, they will supply those things voluntarily, so that should not really affect you guys much at all. The closing disclosure is required to be executed by the borrower at least 3 business days prior to loan consummation. While limited, there are a few situations that require a redisclosure of the closing disclosure. The closing disclosure, again, is the one that's replacing the HUD and the TIL at closing. So that requires a 3 business day wait period prior to them signing their loan documents. Now, the items that can affect these changes and the having to redisclose again would be if there's an APR change. In other words, that comes up if, say, the client was floating, or if a repair issue comes up and somebody says, hey, can we bump up the rate in order to do a lender credit, then that would be when the APR change would affect. If it goes above 1/8% for a fixed rate or 1/4% on an ARM, then we would need to redisclose the closing disclosure and the 3-day clock would start again. The second time that would become effective would be if there's a loan product change. The borrower goes from a fixed rate to an ARM or vice versa. So those 2 items rarely happen right before closing, so I'm not overly concerned about that, but just be aware that if it does happen at the end, there would be a reset of the clock. So what Movement is doing to prepare for TRID? Movement will be producing the closing disclosure ourselves instead of relying on settlement agent. What this means is that currently, when we get to final loan approval, we would go to the escrow department and ask them to prepare the HUD, send it to us, we would look at it, review it, request any changes, and it would go back and forth until the HUD is approved. We no longer have to rely on escrow to prepare the HUD for us or the closing disclosure. We will do it directly ourselves. And that is something that actually I think is a good change because it saves some time towards the end, and we can disclose that closing disclosure earlier in the process to the borrower via e-signature, start that 3-day clock. So our anticipation is that the timelines should not be extended in most cases. Movement has created a pre-closing department. So we've got it already in operation and it's being beta tested. This is in an effort to produce the closing disclosure early in the loan process. Once the loan has received underwriting approval, the department will work with the settlement company or escrow company to produce the closing disclosure well before closing. We're making every priority to have processes and technology in place for working with settlement companies. Communication between Movement, the settlement companies, and the agents is key to produce an accurate closing disclosure well in advance of closing. So this is where you as the agents come in. Make sure up front, I know you've got a lot of partners with escrow companies and title companies, so when you're selecting those companies and you're talking it over with your borrower, be sure that you have a company that's going to be quick in getting us their fees and their numbers early in the process. So in a normal transaction now, when we get a contract, one of the first things that we ask for is the title and escrow contact information. So that's not really going to change. One thing that I notice as a loan officer is that I get many contracts that simply say Chicago Title, or they say First American and Smith. Having full, complete title and escrow information in the contracts will be key to getting things started, because we will need to reach out to the escrow company and have them provide their fees up front so that we can start working on this closing disclosure early as possible. We still have our 7-day processing goal, which means once we submit the loan to underwriting, we want to have it ready to be closed in 7 business days. So with that goal in mind, we're going to need to get this closing disclosure ready to go real early in the process. So if you have escrow companies that drag their feet, find a partner or an escrow company that you'd like to work with that's going to be real quick on the front end to get us those numbers. One thing we're going to do to help with that is we're going to implement an e-portal where escrow and us will be able to put together the closing disclosure, and then escrow will be able to look in and say, yes, those fees look great, and just click in and it's done. Or they can go in and make the necessary changes. This will help a lot with and eliminate a lot of emailing back and forth, and just have one hub where everything can be taken care of. We are working with top industry experts and third-party service providers. Movement's compliance with all applicable rules and regulations allows us to continue to provide an industry-leading level of service to our realtor partners and clients. I am really proud and excited about the proactive approach that Movement is taking to ensure that our timelines are on time and that we make it as easy as possible with you guys. As always, communication is key. Letting your clients know up front that the faster they can respond to us in getting us the loan documentation that we need up front, in getting us all of their paperwork, and in a timely manner is really going to help move things along, as always. Emphasizing to the borrower the importance of signing and returning the closing disclosure as soon as possible. The date it is signed begins the 3-day waiting period. It excludes Sundays and federal holidays. Be proactive in helping the client select their settlement agent. We already talked about that. Here is the loan estimate timing. So consumer submits all 6 pieces of information for application. A technical application would happen once they are in contract, because one of the 6 pieces of information is the property itself. So once I receive a contract, that starts the TRID timeline. Within 3 days, the loan estimate is due to the consumer, 3 business days or less from application submission. Well, this is no different than it is normally now. As of right now, we already have to submit the good faith estimate within 3 business days, and we do so 99% of the time or 95% of the time via our e-sign disclosure system. That way, as soon as they acknowledge and they complete the e-sign, we have a stamp, and that's when our timeline can move forward. So really, the loan estimate disclosure timeline is nothing different than we already have in place. So on the 7th day, 7 days must pass after they receive their loan estimate before we can close. That also is the same as now. 7 business days after the GFE has been disclosed is the earliest a loan can ever close. Now, that rarely happens just because most people don't get everything in quick enough to actually close in 7 business days, but basically that's the same as it's always been. On the 10th business day, the loan estimate is valid for 10 business days after its delivery to the borrower. Borrower must indicate intent to proceed with the loan within this time lock. So there's still a change of circumstance that is allowed, very similar to the good faith estimate, and that portion really is not something that you guys really need to worry about. It's something that goes on behind the scenes. So all documents must be delivered to the borrower no later than 3 days prior to closing. So closing from a lender perspective means signing, okay? Specific tolerance levels exist between the loan estimate and the closing disclosure, which is how it is now with the good faith estimate and the HUD, which must be adhered to, otherwise lenders may have potentially forfeit fees owed, okay? You're not really concerned about that portion. So basically, once we get to loan approval, we will send via e-disclosure the closing disclosure to the borrower, and they will acknowledge it most of the time, whoever has email access, via e-sign. Once that happens, the 3 business days start, and then they can sign, fund, and record. So for the purposes of movement, Saturday is always considered a business day because we are considered open on Saturday. So it would be, you know, if we send it and they sign it on Thursday, then Friday, Saturday, Monday, Tuesday would be the date that they could sign their loan documents, and then we could fund and record. So that's already the basics. We've kind of just flown through that fairly quickly. I wanted to address a couple of frequently asked questions. And one is, I heard that there are 2 definitions for business days for TRID. Is that true, and how does that affect our transactions? So yes, with the loan estimate, a business day on which the creditor's offices are open to the public. So say Bank of America is not open on Saturday, then the business day would be Thursday, Friday, and then Monday. It just depends on, there'll be a case by case depending on the lender that you're working with. The closing disclosure is a little bit different where it counts Saturdays. So depending on your lender, those 3-day wait periods for the loan estimate and the closing disclosure may be different. With Movement Mortgage, it's the same regardless because we are always considered open on Saturday. Question number 2, TRID requires the closing disclosure to be provided 3 business days before consummation. Is consummation the same thing as closing or settlement? Most of the time they occur at the same time, but consummation and closing settlement are 2 legally distinct events. Consummation occurs when the consumer becomes contractually obligated to the creditor on the loan, not necessarily when the consumer becomes contractually obligated to the real estate transaction. The point in time when a consumer becomes contractually obligated to the creditor on the loan depends on applicable state law. So we are licensed in 50 states currently, and we are working and researching the laws in each state to ensure that we are hitting those timelines specific to your area. Third question, we are still concerned that loans are going to be delayed by changes that require new waiting periods. What are the circumstances that require new waiting periods? So we discussed this previously. Basically, they are an APR change of an 1/8 or more, or a quarter more for an ARM. It is a product loan change, and if a prepayment penalty is added. Movement Mortgage does not have any programs that have prepayment penalties, so that one, you know, at this point in time would never apply. Many things, and talking with realtors about this as I've been going to some of these trainings and attending some of these trainings, is, you know, okay, what happens if we go to a walkthrough and suddenly there's repairs that need to be done and we need to issue a credit? So if a credit comes up and needs to be done, that should not affect the 3-day wait period. In other words, if we've already sent the closing disclosure, the borrower has signed it, and our clock is ticking, and then they go do their walkthrough and you want to add a $500 real estate credit, we can still do that without having to redisclose the closing disclosure again, okay? So that is the understanding at that timeline. So I know that that was one of the key questions that comes up, because there are a lot of things that happen at the last minute on real estate transactions. I would say get those things done as soon as possible and early, so that our closing disclosure is as accurate as possible early on in the transaction. But, you know, in the rare instances that it's just unavoidable, that in itself would not cause a restructure of, you know, redisclosure of the 3 days. So unless there's no other way to help, the seller is just completely not compliant, the buyer's saying we're walking away from the deal, the realtor says I can't possibly credit, you know, that much money, and the only option is to bump up their rate a little bit to offer a lender credit, then we would have to redisclose the closing disclosure and the 3 days would start again. But for the most part, I think that that would happen fairly rarely. So this is what the new handouts look like. Actually, sorry, I mixed that up there. This is what the new integrated disclosures look like. On the screen, you're not really going to be able to see them very well. So in the handout section, on the little box of your webinar, is the TRID closing disclosure sample and the TRID loan estimate sample. So you can go on there and click on those, and then you can look at them a little more closely. Now, I'm not going to go through these line item by line item. They're very straightforward. You'll see when you're looking at them that it's a breakdown much easier to read than the HUD and the GFE ever was. So in my opinion, I actually think this is a good change. I think it's very clear. It's an unassuming looking form. I think the borrower would be less intimidated looking at it, and they're just really easy. So I actually really like these new forms. So take a look at those, and if I can get to my screen here, I'm going to move this along. Can't see my little arrows. Anyway, I'm going to go ahead and open it up to questions. I've just really hit on the key items that you as agents need to know. If you really want to get into all the nitty-gritty about mailing disclosures versus e-sign disclosures versus hand delivering, we can chat about that too. But the main thing that I did not mention that I wanted to bring in is that in the rare case that a client does not have email access, say they're an older client, or they live in a cave, or who knows what, that's when hand delivering the closing disclosure would be the most optimal. Because if we mail it, we have to wait 3 days, assume they've received it, then we have to get them to sign it and send it back before the 3 days starts. So when someone does not have email access, then that's when the realtor will be key in possibly assisting with this. Say I'm working with somebody in Northern California, or wherever, and the realtor happens to be closer to the client than I am, then if he's down the road and can hand deliver, sign that closing disclosure and get it back to me via fax or scan, then we can start that 3-day wait immediately. So that's just one way that realtor may need to step in to assist in hand delivery. Otherwise, it would be taken care of just like we do anything else that we have the borrower sign. We have them come in, we go meet with them, and get that hand delivery to start that clock. So I'm going to try and move my screen along, but I'm going to open it up to TC, and he will look at the questions that you've submitted, if you've submitted some, and we'll go from there.
Okay, this is your moderator. The floor is now open for questions. I see many of you have been asking questions throughout the webinar. Please begin to post your questions, and as I read them, I will read them off to Shelly and giving her an opportunity to respond directly to you live here on the webinar. So one moment, please excuse the silence while I queue up our first question. Dottie Greco asked, how does this work on 203K loans?
On 203K loans, it would work just like any other loan.
Excuse me, I read it incorrectly. How do you think this will affect 203K loans?
I don't think it will affect 203K loans any differently than any other loan. Movement Mortgage does have a designated 203K processing underwriting department. We are huge on 203Ks and renovation loans, conventional. So the process would be exactly the same. The only loan types that are not affected by TRID is a HELOC, like a home equity line of credit or a second, or loans that are on, say, a mortgage on a manufactured home that's not affixed to real estate, and reverse mortgages. Otherwise, all other loan types, 203Ks, renovation. A 203K is just an FHA loan, so it wouldn't be affected any differently than anything else.
The next question comes from Barb Gray. If there was a last minute credit, doesn't that require a redraw of the closing docs disclosure?
Yeah, we addressed that a little bit. So if it's a lender credit that's going to change or affect the APR, then yes. But as of now, the only items that cause a redisclosure and the 3-day wait period to start over is a change in the APR, a change in loan program, or adding a prepayment penalty. So a last-minute credit from the realtor or from the seller should not start the 3-day clock over. If you do have a last minute credit, it most likely will need to go past underwriting just to make sure that it is not, you know, exceeding the allowed amount that a seller can credit. Otherwise, we should be fine. I still always recommend that they come in sooner, but if you have a last minute, that should not affect the 3-day wait period.
Okay. The next question comes from Casey Stuto. On day 10, I must have the rate locked. I cannot float and lock later. Questions?
Well, floating and locking is kind of an interesting, in most transactions, I really try to have the loan locked within 10 days because getting the loan locked does require a redisclosure in itself, which is done via e-sign. So someone can float, but only for a certain period of time, and it really just depends on your the length of your closing. As far as how TRID will affect those first 10 days when it says the disclosure is where it said the loan estimate is good for 10 days, the change of circumstance could be that they've decided to lock, and then we would redisclose. So that portion really is the same as it is now, in that we have to have the loan locked. Typically the longest we'll wait is maybe, you know, 10 days before closing if the borrower really wants to float. Otherwise, you know, we do try to get them locked so that all the proper disclosures can happen. One thing I should reiterate is, as of right now, we disclose via e-sign at the beginning with the loan disclosures, again at the rate lock, and then it will be the main change with all of TRID is that there will be a third e-disclosure with the closing disclosure. So I know there's a lot of kind of everybody freaking out over TRID and all these wait periods and all this stuff, but as far as you guys as realtors are concerned, the only real main difference is that the forms look different and we have to disclose that one last time prior to closing. But I'm not really anticipating it causing any extra delays from our part at Movement Mortgage.
Michael Green asks, does your firm provide FHA and Cal HFA in Southern California?
Yes, we do. We do have the down payment assistance programs. We have the Cal HAFA. We also have the Platinum Plus program, and the answer is yes. Basically, Movement Mortgage offers pretty much all of your mainstream programs, you know, FH government, conventional, FHA, VA, USDA, where it's area accepted. So yes, we do.
Okay, Joseph Dananati asks, are any flyers or disclosures due to borrowers from CFPB or that will be prevalent to advise the borrower that they need to be on their toes due to the timeliness and e-signatures needed and emailing attention? I hope you got that.
I think what he's asking is there any kind of flyer or something that kind of lets the borrower know that they need to be on their toes? From my perspective, there's not an official. I think if what you're asking is there an official like pre-disclosure to the disclosure, no, but there is a process, and that is probably going to be lender and loan officer specific and realtor specific. You know, setting the proper expectations up front with your client is key. I do have email instructions that go out prior to the initial disclosures that says you must respond within 24 hours to this email, or we will have to mail out everything, and that will cause a 3-day delay. So ongoing communication, just letting them know up front, watch your emails. I let them know to watch their spam, you know, their junk folders. I have a very detailed instructions that shows them. Now, we all know the clients don't usually ever read anything we give them. So it's just a matter of constant communication. I communicate via text, cell phone, and email with my clients and agents, and whatever way works best for the client so that I make sure that they understand that we are on it. is what we do. Now, with our 7-day processing goal, our processors only get bonus. It affects their bottom line. If they miss this 7 days, they lose their bonus. So even when we're doing our TBD approvals, which means they haven't found a property yet, we are still in constant communication with the client to get everything into us, get all the conditions in, so that we can be ready and cleared to close in 7 business days, even if it's a 60-day closing, even if it's a new construction and doesn't close for 6 months, even if it's a TBD. So when we're working together, if you can assist in letting the client know, hey, you know what, get it all in and get it early, then we don't have to worry about it. Then the client, won't get irritated about us asking for everything so early on. We really are proactive. We're all hands on deck, and myself, my assistant, and my processor will be requesting items from the borrower to try and get everything in and get our conditions in and ready to close within 7 business days as much as possible. Right now we're at 70% of that happening 70% of the time.
The next question comes from Rick Tibbetts. His question is, I noticed that the MI indicated on the closing disclosure shows in the 1 to 7 year column, but not in the 8 to 30 year column. Is this because based on the projection of the removal of MI based on equity gain?
Are you looking at the loan estimate or the closing disclosure? Let me see, the mortgage. Mortgage insurance does have a different premium depending on the year and the program. This is an estimate, so if it's like an FHA and they're going to have it basically forever, then it would disclose it that way. If it's going to be conventional and it has a 1 to 8 year term, then it would be reflected differently depending on the program and how the mortgage insurance actually is affected. As of right now, mortgage insurance is still for conventional, after 2 years, the borrower can request to get it removed, and it is up to the lender to determine whether or not that can be removed. FHA, just in general, depending on how much money they put down, they're pretty much stuck with it for life. If they have a larger down payment, I think it's a minimum of 11 years, but in general, I just let people know with FHA they're kind of stuck with it. But I hope I answered your question, Rick, on that.
The next question comes from Denise Mitchell. Please explain the TIP of 69.45%.
On what? Is that on the loan estimate or on the closing disclosure?
Denise, if you could type in a follow-up, that would be helpful so that we can get your question answered.
I don't have the forms open while I have the screen. TC, am I able, if I pull that up, are they seeing me playing around with that? It doesn't matter.
No, not on yours. You're free to pull up anything on your desktop.
Okay, because I haven't been
looking at that. Her follow-up was loan estimate.
Oh, on the loan estimate, she's looking at the TIP.
She said page 3.
Let me look at it. Total interest percentage. You'll pay over the loan term as a percentage of your loan amount. To be honest, I do not know. I don't know what that is. I'm going to be honest. I'll find out. I don't know what that percentage is. That's interesting. 69.45. Yeah, it's over the life of the loan, so I think it's kind of combining the till. See on the APR here, if the note rate, say, is 3.75, like let's just look at this loan estimate. The note rate, what is it on this one? 3.875. Okay, so when you scroll down on page 3, this is the till that they're normally looking at, which is the truth in lending statement. That's the one that if you look at the form now, it has 3 boxes at the top, and on the left it has the APR, and then it has that huge number that says the total amount you'll pay for the loan. I think what they've done is they've converted it to a percentage rather than a number, because on the till it'll say, okay, if your home's $100,000, and in the third box it'll say total you will have paid for this home at the end of the 30 years, and it usually is like 300 and something or triple. I think what they're doing on this form is they're converting it to a percentage rather than just putting the number. Does that make sense? I hope that makes sense. But this is the till portion of the form, because the GFE and the till are now combined into the loan estimate. So that's taking into account the total life of the loan costs.
The next question comes from Kathy Newman. What's best for timing? 45-day closing, 35 days? Is there a difference for conventional versus FHA, USDA, VA, etc.?
My favorite kind of closing is 20 to 30 days. We traditionally close our loans in 20 days or less. So that's the way I like to close them. When they linger on forever, it seems like I'm, watching paint dry. I can only speak for us. I know with banks, you probably are going to want to have at least 45 days, especially some of the big ones that tend to really drag their feet. And I don't know what their processes are, but just assuming based on some of their other really slow processes in general now, that these additional closing disclosures could cause delays. I really don't know. For our purpose, if it's an FHA conventional loan or high balance loan, meaning anything that's not a full jumbo, anything between 20 and 30 days or even 14 days in an emergency is fine. VA loans, I like to have 30 days. We still close those between 20 and 30 days, but I like 30 days on a VA just because of the 10 days for an appraisal. USDA, probably the same idea. You probably want 30 days. For the renovation loans, you want 30 days. The only time we want 45 days is on jumbo loans that are brokered out. So then we like to have 45 days because we can't always control a portion of the loan that is brokered out. But I would say 90% of our loan products are underwritten and processed and funded in-house, which is why we can close them quickly.
The next question comes from George Bigelow. Where is there, or is there, elevated disclosure liability with the agent, or is this primarily a lender issue?
This is primarily a lender issue. The reason you guys need to know about this is so that you can help manage the timelines and the expectations of your agent, of your client. So no, you do not have to disclose any of this closing disclosure. You will not, hopefully on your end, you're never going to have to go through one of these loan estimates. You really are very, you'll probably look at the closing disclosure at the end to make sure that credits and everything are in there and that kind of thing. But as far as the liability of the agent disclosing these forms, no, it is a lender issue.
The next question comes from Shelby Ramirez. Will there be a limit on the possible credit if needed?
There's already limits on the possible credits for third-party credits. Depending on the loan program, it's anywhere from 3 to 6%. Rarely does it come up that we're, exceeding those limits, except in cases in areas where you've got lower loan amounts. So, if you've got purchase prices that are $150,000 and loan amounts of, say, $80,000 or something, then it might come into play. In general, FHA can go up to 6% of interested party credits. Conventional is generally 3% depending on your down payment. But as an agent, if you're just keeping it between 3 and 6%, then you're probably fine. Always ask me if you're not sure, but that is the one thing that we run past, that underwriting always wants to see, is to just make sure that we're within that percentage guideline. Otherwise, and that's not changing. That's the same as it's always been.
The next question comes from Mary Jane Harris. Will pre-approvals or pre-quals still be able to be provided before we show buyers properties?
That's a good question, and that is a question I was asking our TRID compliance person as well, because when I see we can't, collect documentation without having them sign the loan estimate, that made me a little bit nervous. But basically, it's not considered a loan application until there is a property. That makes it a formal loan application, which is the same as now. Once we have a value in the system and we have a property disclosed in the system, that starts our 3-day clock where we have to send out the good faith estimate. It's going to be the same moving forward with the loan estimate. So as long as it's a pre-approval, if a client calls me and they say, I refuse to send you any documentation whatsoever until you send me a worksheet or this and that, then I can pull their credit, do the basics just based on a conversation, and kind of give them my best estimate. But until they're in a property, I really can't send them out a formal loan estimate because they're technically not a full loan application. 90% of the time, clients that come to me, they want sound advice, they want to make sure that their numbers are accurate, and they want the pre-approval to be as accurate as possible. So when I request that documentation, so I have all the pieces of the puzzle, it'll be up to the borrower, really just like it is now, whether or not they want to provide that information so we can have a full pre-approval. We will still be providing our pre-approved underwriting process, which means we collect all the documentation just like a live file, we submit it to underwriting, we condition it, we gather it, and we get it ready to close in 7 business days, so that once they have a property, we go live, and then 3 days later we have to send out this loan estimate. I'm anticipating it's going to work very similar to the way that it does now. I'm not really expecting any changes in that.
Jim Dreyer, his question is, what are the 6 items you need prior to loan estimate?
I knew somebody was going to ask me that. Okay, so it is the name, the social security number, the property, the value, the I'm going off the top of my head here. Let's see, the name, the social security number, the address. I believe income is one of them, and I'm missing one. I'll have to get back to you on that. I'm drawing a blank. I'm sorry on the 5th one.
Okay. Catherine Newman, her question is, what would be best practice for back-to-back closings? Need to close on current home in order to purchase a new one, timing-wise.
Okay, so to me it's going to work just like it does right now. In Southern California, concurrent closes and back-to-back closings and contingent offers are becoming very popular and common, as many as sometimes 5 on down the line. So the best thing if you can do the closings so that possession is closing plus 3 days, that is probably the safest way to do your contracts when you have concurrent closings, just so that you've got, if my loan closes, then the seller needs to get out. If they have 3 days to do that, that gives the next one time. We typically do time them where they will fund. If I'm doing both ends, which sometimes I have done, where I'm working with the buyer on the buyer for the seller, okay, and also if my buyer is selling their house and they had me pre-approve their buyer, then that works out great, and we just pool it all together and we can close them same day or the next day right after one another. If it's a VA loan, there might be another day or so in there if the buyer needs to reinstate their VA certificate of eligibility. In other words, they're closing one loan and then buying another VA. There might be a day where that has to be reinstated, and it kind of just depends on the VA. Otherwise, if you put in your contract closing plus 3 days for possession, then you should be okay where nobody's going to be displaced. Just depends on how many people you have on down the line, and etc.
Joseph Dan Antoni asks, does the buyer need to pick a property first before they can have a pre-approval or pre-qual? Is it black and white?
Well, that kind of goes with the other question. No, they do not have to have a property first to have a pre-approval. So a pre-qual, if the client does not want to supply any documentation, then I would just let you know, hey, you know, I've got a pre-qual based on a verbal conversation and credit. We will not issue a pre-approval letter if we haven't seen any documentation. I don't feel comfortable putting myself on the line and saying that this is a good deal and we're going forward if I haven't seen any documentation. So that's going to be up to the client. If the client does not want to comply, then it's up to you and the client to decide whether you feel comfortable enough showing them homes until they get a property and can do a full approval. But no, they do not have to wait to get a property to get pre-approved. And I highly recommend that they don't wait, by the way.
Rick Tibbetts, on page 3 of the loan estimate, it shows a comparison section with information a buyer would use to shop lenders. Is this section a fair estimate that will truly allow for a fair comparison of lenders, or can this be manipulated in some way to skew the comparison?
This is already on the good faith estimate, so let's see. Basically, when they're getting this loan estimate, they are getting this after they're already in a property. It may or may not be the locked version. So I get the contract today, we update the file accordingly. In order to get the appraisal ordered quickly, I get the file disclosed right away, the same day or the next day as receiving the contract, whenever possible, because we can't order the appraisal until we have the signed initial loan estimate disclosures in the file. Then we can order the appraisal. Now, if they're floating, then this number might not be the exact final number when they're comparing from one to the next. In general, unless a borrower is pretty sure they're moving forward and the lender has their contract, they're probably going to get worksheets and estimates like we've sent out previously at the pre-approval stage, just so that they can kind of have a general idea of how things look. And those could be skewed or manipulated anyway. A lender, they could put in 2% rate if they wanted to in a worksheet, and then all of a sudden when they get into contract, this loan estimate is at 4.5. So you never know what an unscrupulous lender is doing out there. But the one on the loan estimate should be pretty close, as long as the locked version matches the original loan estimate. But yeah, this is the same as the TIL, which a client can go and say, okay, the APR at one lender is 4.2 and the APR at another lender is 4.1. One thing to keep in mind, though, is that the APR doesn't always tell the full story, because I might estimate escrow fees at a more reasonable or closer amount, or even a little on the high side, which can affect the APR, and another lender might make them real cheap to get their estimate looking short, and then their APR is going to be a little lower, because escrow fees do affect the APR. So that's one area where really, if I have a client who's comparing, I'll ask them to show me the other lender's information so that we can really go through it line item together. But the loan estimate should really not be able to be manipulated except between the original loan estimate and the locked version.
Catherine Newman, are you anticipating that the new rules will make sure funding, parentheses, wire, is available at the closing table for the scheduled closing?
TRID really won't affect how lenders fund. It's really lender specific. So I can tell you how we fund. Currently, right now, once we have final loan approval, the closing department goes over to the escrow, requests the HUD. As soon as the HUD is approved, we will set up the wire with the loan documents. In other words, HUD is approved, we talk to escrow and say, okay, if closing date's on the 30th, what day does everybody want to fund? And everybody says, we want to fund on the 27th. Great, we send the loan documents with the pre-funded wire for the 27th, okay, or whatever date is agreed. We do not need the signed loan documents back before funding. So the only thing that we do is get the HUD approved, or in this case, with the new, once these new rules go into effect, we won't really even need to wait on escrow. We'll just send out the closing disclosure. As soon as the borrower accepts it, we wait 3 days, we'll send the loan documents and the funding wire pre-set up. So that's the way that we do it. We just need to make sure that the escrow company will have enough time to sign the buyer and get the information back in time to get it to the title company so they can record. So I guess the question is, yes, we do send the wire with the loan documents, but TRID will not affect whether some other lenders, you know, still need the loan package back to review or whatever they do. I can't answer that question, only that they have to wait that 3 days before they can sign, and then the funding and recording would happen as usual.
Okay. My next two questions are movement mortgage specific items. Denise Mitchell, do you do construction loans?
We do not do construction loans. In other words, if you're buying a piece of land and you want to build on the loan, no, we do not. We do offer loans for new construction on homes that are completed, you know, once completed, but we do not offer the actual money for that construction unless it is an FHA 203K or renovation loan. With an FHA 203K, a client can, as long as they use the initial foundation, they could literally tear the house off the foundation and rebuild it. So in that regard, yes, we are kind of providing construction loans, but in, I think, the means that she's asking the question, no, we do not provide a land construction package, and nor do we do land-only loans.
Shelby Ramirez, does your company offer Texas Vet Loans, which is a loan for veterans who started or retired their military careers in Texas?
I know that we do offer the CalVet because I am not personally licensed in Texas, but we are licensed in Texas, so I would assume if there is a Texas vet loan just like the CalVet, that yes, that would be available. I can't tell you for certain. I would have to find out for sure. If you want to email me directly and ask that question so I can have a Texas loan officer get back with you, then please do that.
Is Movement Mortgage a direct lender?
Yes, we are a national direct lender, and we do all of our own underwriting, funding, etc. We are direct to Fannie, Freddie, VA, government, and we have the highest direct status.
Okay, there are lots of additional questions coming in, and thank you for such good participation, but I do want to be respectful to Shelly's time. Shelly, we're right at the 55-minute mark, and I'd like to give you an opportunity to have any closing remarks before we end our webinar today.
I would just say if you still do have specific questions, don't hesitate. You can, this number that's on the screen here is my cell phone. You can call or text me on this number. You can email me. My email address now is actually shelly.hoiseth@movement.com. We don't need the mortgage in there. I just now noticed it. If you do use the mortgage, it will still come to me, but shelly.hoiseth@movement.com is the new address. So just email me directly any questions that you have, and you know, I'm happy to chat with you or go over any specifics that you have.
Okay, well, everyone, thank you for your time today. Shelly, thank you. You've been gracious with your time and the expertise that you've provided us today. This information will be emailed out to you, the slides and the samples that were provided in the download today, as well as a recording of this webinar will be emailed to you here within the next few days following the webinar today. So thank you for your time. You all have a good day. Goodbye.
Thank you. Bye-bye.